to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, this is Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View. Today, we're going to focus in on different tax-efficient strategies surrounding the Roth IRA conversion strategy. So that's going to be our primary discussion as it relates to commercial real estate development. I'm joined with two other team members today. One is Victor LeBlanc, who's on our investor relations team. And I also have Tim Witt, who really runs and is part of our tax strategies at Peachtree. Let's go ahead and sort of jump into just how it works with a Roth IRA conversion, because I know we get a lot of questions as it relates to how that strategy works. Tim, so if you could just sort of open it up and explain to the listeners today how a Roth IRA conversion works and how it works as it relates to commercial real estate.
Sure. And Greg, thanks for having me with you today. I know we've been together before talking about DSTs, talking about opportunity zones. So it's great to talk about this particular tax strategy. And when we talk about tax strategies, I always like to start off with kind of a disclaimer that, before, you as an investor, invest in a tax strategy, you really should consult with your CPA, make sure you can take full advantage of the tax benefits of that particular, investment or that strategy. And also, I'll say that I'm not a CPA, and I'm not your CPA if you're listening. But with a Roth conversion, let's just talk broadly about what's a Roth IRA versus a traditional IRA. With a traditional IRA, you contribute money pre-tax. It grows tax deferred, but then it's taxed at ordinary income tax rates when you take it out, sometime in the future in your retirement years. The Roth is really the opposite, where you're putting money in after tax upfront. It grows tax deferred, but then there's no tax liability when you take that money out of that Roth IRA later in life when you're in your retirement years. And with a traditional IRA, after a certain age, you have required distributions. We have to take so much out every year based on formula that the IRS provides based on your life expectancy. And so you'll have to take that out. You'll be taxed. And if you die, your heirs are going to be taxed on that as well. Versus a Roth, once you put that money in, there's never any tax liability on that. No income tax, no inheritance tax. It's yours, free and clear. So there's a lot of benefits to getting more and more of your retirement dollars into a Roth account versus a traditional IRA account. Now, the problem with that is, the IRS imposes limitations on how much you can contribute to a Roth IRA. The max you can contribute in 2026 is $7,500 if you're under the age of 50. If you're 50 and older, you can contribute $8,600. So one of the limitations there is that, like, if you're 20 years old, starting out, that's great. But if you're older, if you're 40, 50, 60, that's not a lot of money that you can put into your Roth every year to get to a large amount by the time you hit retirement age. The other limitation is that there's income caps. And so if you're a single tax filer and you make more than $168,000 a year, you cannot contribute to a Roth IRA. If you're married filing jointly, if you make more than $252,000, you cannot contribute to a Roth IRA. And so even while there's all these benefits to it, there's limitations to how much you can actually into that Roth on an annual basis. And some people just cannot contribute anything because of their income level. So with a Roth conversion, and this is allowed under the tax code, where you can transfer assets from your traditional IRA to your Roth IRA, and there's no limit on how much you can contribute, how much you can convert in any given year. The one catch is, though, you're going to pay taxes on the amount that was converted at ordinary income tax rates. And so you're going to have money at a custodian that's holding your IRA funds. When you do the conversion, and they'll have a form that you can fill out that you say, I want to convert this asset from my traditional IRA to my Roth IRA. At the end of the year, they're going to issue a 1099-R, which will be reported to the IRS. And so you will have to pay ordinary income tax on the amount converted. And so one of the benefits of a Roth conversion strategy, there's a way that you can minimize the taxes that are due, and that's through investing in a commercial real estate development project. And so how this works is you're going to have your traditional IRA. You will invest in that development project with the dollars in that account, and that will be held at that custodian. And there's what we call the J curve when it comes to real estate development, and it's really looking at what's the value of your investment through that development cycle. And so, for example, if you put in $100,000 into a project with other investors, you're pooling your money. You have expenses before you're even bringing a shovel out. You have pre-development expenses. You have engineering, architecture, zoning, entitlements. You're spending a lot of dollars before even bringing a shovel out. Then eventually you get to the point where you can start doing some site work, and then you're going vertical from then on. But in that phase where you're mid-construction or even before you're starting construction, and the value of that investment is lower because a partially built property, if you actually go out and try to sell a partially built property, there's not many buyers that want to step into a half-built construction project. And so your value is going to be temporarily depressed because you're mid-construction. And then at some point, you get to completion and you start stabilizing, you're leasing the property up. And at that point, the goal is to get it back to where you started, back to the $100,000, and then for that value to continue to grow as you reach stabilization and grow income at the property. But that midpoint, the kind of that low point of the J curve, that's the ideal time to convert this investment from your traditional IRA to your Roth IRA. So maybe that $100,000 that I talked about before, maybe it gets discounted to maybe it's $60,000, $70,000. Do the conversion at that point into your Roth. Now you're paying taxes on $60,000 or $70,000 of income rather than paying taxes on $100,000 of income. And then once it's in your Roth IRA, then hopefully as that J curve and that development gets completed and stabilized and creates value, then hopefully your goal is for it to be worth more than $150,000 ultimately. So it's a very efficient strategy and a very efficient way to do that conversion and to help minimize. It doesn't eliminate your taxes in doing the conversion. It'll help reduce that tax liability while you're doing that conversion.
Just to sort of help summarize it, just make sure I understand it fully, Tim. You have an IRA, right? And theoretically, I have $1 million in IRA. I can go take that money and invest it into a real estate project that's a new development project. And because of the J curve effect that you're talking about, when I convert it into the Roth IRA, I get the discounted valuation because I'm getting it valued at a certain period of time where it's got the weakest value because it's midway through construction or it's at some midpoint in construction. Not to mention it's got you're investing in a passive partnership. So there's probably a discount associated with that. And then, I've got to pay tax on the new valuation, which hopefully is lower than the original invested amount when I do that conversion. But ultimately, the capital that's now in the Roth IRA can grow 100% tax-free from there on out. Is that correct?
And not only grow tax-free, have no taxes when you take distributions from that Roth IRA when you're in your retirement years.
So this is a great way for someone that's that built up a lot of money in their IRA. And I guess technically you could have worked somewhere where you built up a huge 401k that converted to an IRA, I guess, right? At some point, is that how
and that's where most people end up with a large IRA is from a 401k conversion from a prior employer.
Got it. And then eventually you can take your IRA, you can convert it to this Roth IRA to allow it to not only continue to grow tax-free, but to pull distributions out tax-free. So if you're investing in really strong projects on the real estate side, this could be a very, this could not only help you be very efficient on the tax side and save some money, but it can also help you, potentially make a lot of money on the other side if you've invested in the right type of projects. But with that, Victor, why don't you jump in with some questions? I know you have a lot of questions that you receive all the time. Working in our investor relations departments, I would love to hear the feedback you receive on the street.
Yeah, I think most, investors at least, understand the J curve when it comes to limited partnerships, particularly in real estate. A common question I received, at least off the bat, is, can you dive a little bit deeper into the valuation methodology and more kind of how the discount comes in? Because you don't often see that in all LP projects out there.
Yeah, no, that's a great question. And I think it's important to understand that we don't pick a value, internally at Peachtree, right? We're going to go out and hire a third-party appraiser who's an expert in doing these types of evaluations, and they will be the one that they will determine that the new reduced value. And so it's an independent, objective analysis that's done of the project. There's two main methodologies that you could use. Number one is you could just value the actual real estate itself. Again, looking at, okay, what's this project worth in mid-construction? What's the true market value if you were actually going to transact and sell that before it's complete. The other, say the second typical methodology is valuing the units. Like if because typically it's an LLC or limited partnership you're going to invest in, what's the value of those units, which is typically lower because of illiquidity. As an investor, as an LP, you don't have any control, you don't have voting rights, you don't have any control over timing of an exit or distributions, and as a result, there's often a discount for all those factors. When you're doing a unit appraisal.
You talk about the J curve. What's the time you see, that J, that dip in the value typically? As an advisor out there, when you're looking at clients' traditional accounts, you're looking to do a conversion. How many years could you potentially have to do that conversion?
Partly, well, in terms of the ideal time is when you're mid-construction and you've spent down most of the cash, you're drawing on the construction loan, right? Because you can't discount cash. Cash is cash, and so you want most of that to be the equity cash to be spent down. After the valuation is done, and it really depends on how often that the real estate sponsor is going to update their valuation. And once they do the new valuation at the bottom of the J curve, they probably won't do another valuation until after the project is complete and it's somewhere mid or maybe completely stabilized. And so there might be a couple year period. And so it could be very advantageous to do a conversion over a multi-year period. And so let's say you're going to invest $200,000, in a development project in your traditional IRA. You could convert $100,000, let's say, in December of this year, and maybe convert the other $100,000 in January and spread that tax liability over more than 1 year. You're still going to pay taxes, because I invested in one of these myself, and I did all the conversion in 1 year. And I look back, I was like, well, I should have done it over 2 years. So it would have been less painful to to spread that tax over 2 years versus 1 year. So you can do it over a multi-year period. It doesn't have to be all in the same year. But I do think going back to Greg's example, where he says, hey, if someone has $1 million in their traditional IRA, you would not want to take that $1 million and put it into just one development project at one time, right? You want to have diversification, invest in multiple projects over time. And also, if you did it all at one time and created, $1 million tax liability in 1 year, it's going to, throw you into the highest tax bracket. And so you want to really kind of manage that over a multi-year period to get that $1 million, or at least some portion of that $1 million from your traditional IRA into your Roth IRA.
One other piece I'd love to dive into a little bit is common use cases we see for the strategy. I mean, at least from my end, a lot of advisors are looking at it from a perspective of, my client has, RMD years coming up, or from an estate planning perspective, right? If they can get those assets into a Roth, makes it a little bit more tax efficient for passing that down to the heirs. Are there any other kind of common use cases you're seeing?
I think that's, those are the main factors people are looking at. And also, people are thinking about tax rates, right? And, do you have a belief that tax rates are going lower, staying the same, or going higher? Right. And if you have a view that tax rates, whether it's 10 or 20, 30 years down the road, could be a lot higher. I mean, just looking at, our country's, fiscal situation and debt, maybe tax rates could be a lot higher. And so maybe you'd rather pay that tax on that conversion today and have those dollars in that Roth be completely tax-free upon distribution, again, 10, 20, 30 years down the road.
Makes sense. Really from a operational standpoint, how does it work with a custodian? Do typical people have these strategies, available at custodians? And how would it work with a firm like Peachtree Group that, would be revaluing an asset potentially?
Sure. And so when we talk about custodians, that's the firm that's actually going to hold, that investment. Some custodians cannot hold real estate, partnerships or LLCs. They can only hold, traditional, investment stocks, bonds, mutual funds. So you have to have a custodian that will hold this type of asset. And there's several that do. And usually the ones that do are very familiar with this, understand, how this works. And so you'll make sure that you have, first you're going to have an account open at a custodian that will allow this type of investment. So if you don't have that, you're going to open one, then you'll make that investment in that real estate development project. And so let's say the value, let's say it's $10 per share, just to use, easy numbers. And so you invest in $10 per share, invest, say, $100,000 in your traditional IRA at this custodian that will allow this type of investment. After we do the appraisal, again, mid-construction, bottom of the J curve, we have that new value done, that's determined by a third party, not by us. We provide that new value to the custodian and they'll discount it, based on what's in that valuation. So let's say the new value comes out and it says it's, $7 instead of $10. So we report that $7 new value to the custodian. They reflect in all their customer accounts that are in that particular project. Now it's at $7 versus $10. That's the point where you would direct the custodian to convert it from your traditional IRA over to your Roth IRA.
And you mentioned $7. What's the typical range that you're seeing the discounts come in at?
They're all over the board. I think typically, a discount between 30 and 40% is felt to be reasonable and not excessive. And I think that when we talk about tax strategies in general, I kind of think of, two big buckets of risk. I think there's real estate risk and there's tax risk. And we're very focused on minimizing both of those. And so, I think again, the 30 to 40% it can be very typical and would not be considered overly aggressive.
From a IRS perspective, is there like supporting documentation that we can provide them if there were to be any challenges or anything like that?
Absolutely. So if there was ever, a challenge by the IRS, we'd have the appraisal that we would provide to them. Again, not an internal number that we just made up. It's objective, independent, third party expert in doing these type of evaluations, these types of appraisals.
Yeah. And I think one of the last questions I typically receive is, let's say you had $1 million in a traditional IRA, you could invest maybe 100,000 of that into a project like this in the commercial real estate space, but you wouldn't necessarily have to create a brand new traditional IRA just for this conversion. You can convert just that one investment.
That's correct. And again, if you invested $100,000, it's discounted to $70,000, you could convert $35,000 in 1 year, $35,000 another year, and spread that over a couple year period. Again, when you're thinking about, because you're going to increase your taxable income, right? So you want to be thinking about, what's that going to do, and really working with your CPA. What's that going to do to your tax bracket? Are you subject to any phase outs? You really want to make sure that you're going into this eyes wide open to understand what the tax impact will be, so you're not surprised when your next tax season comes around.
As you look at just different projects and so forth, you want to make sure you have a solid project you're investing into, so that hopefully you have appreciation on the back end. Because if there's no appreciation, then this was a sort of, I don't want to say it was a failed mission, but it wasn't something that probably made a lot of sense, right? So you want to invest in something that's going to hopefully grow value. And then once it moves from this, from this traditional IRA to the Roth IRA, again, just getting my head clear around it, the only difference between being in a traditional IRA versus a Roth IRA, as it grows in that Roth IRA, it's now growing tax-free. Distributions come out tax-free. In a traditional IRA, if it just stayed there, invested in whatever, once you start to distribute, you got to pay tax at basically short-term rates, or basically at current tax rates, right? Like not even so. So it's very accretive once you do get to the Roth IRA, especially if you invest in high caliber projects that end up delivering good returns effectively. So this is just another way, again, to help manage your tax situation, but to also be very efficient and really grow wealth. Because the best way to grow wealth, beyond making really good investments into, if you're investing in the public markets, the private markets, making sure you invest in great projects. But the way you really grow your wealth and compound it is through tax efficiency. And that's why we wanted to talk about this today. So if you have any further questions, don't ever hesitate to reach out to, Tim Witt, who runs our tax strategy at Peachtree. Victor LeBlanc's on our investor relations team, and he's very skilled on, how we view this strategy as well as other strategies. So feel free to reach out to them as well as myself. Thank you both, Tim and Victor, for joining us today.
Thank you, Greg.
Thank you.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.